Most high-income professionals in Canada have built something significant: a career, a mortgage, an income, a family. And almost all of them have actually insured their homes, the vehicles, even the iPhone in some cases. But very few of them have taken time to actually protect the assets that pays for it all, their income. In this video, I am going to walk you through what a complete income and life protection strategy looks like for a Canadian professional. By the end, you would know exactly what you need and what questions to ask before you buy anything. Let me ask you a question. If you had an asset worth $5 million, maybe a piece of real estate, an investment portfolio, or perhaps a business, would you leave it unprotected? Of course not. Now, consider this. If you're 35 years old and you earn $150,000 per annum and you plan to work till age 65, your future income is worth $4.5 million. That is $4.5 million assets sitting unprotected. So if you become seriously ill, or you get injured, or perhaps you die unexpectedly, that $4.5 million disappears. And the mortgage does not disappear with it. The school fees doesn't disappear with it. The family support, the plans, the vacation plans don't disappear. Now, I'm not trying to be pessimistic here. I'm just trying to get us to look at it as a whole, because a good protection strategy covers everything. Now, the question most people have is, should I get term or should I get whole life? Here's the honest breakdown. Term coverage protects you for a defined period of time. It could be 10 years, it could be 20 or 30 years. Now, if life happens within that period, your family gets the benefits. If nothing happens to you, your coverage ends. It's actually the simplest, most affordable coverage in Canada. A healthy 35 years old individual can get $500,000 coverage for as low as $30 or $40 per month. But unlike the term policies, the whole life covers you permanently. It doesn't have a tenure. And it also builds cash value. This is something you don't find on the term. In other words, for the whole life policies, the cash value grows over time. But again, because it has cash value and it's permanent, the whole life costs significantly more, at least more than 5 times the cost of the average term policy. So here's the framework that I use. Start with term. It protects your family during the years of high financial obligations. Like you have young children, you have mortgage obligations, and of course, other income dependents. As your wealth grows, that is when conversations around permanent coverage sets in. And the good thing is you can actually transfer or convert your term coverage to permanent coverages. Yeah. So the next question is, how much? There are several ways of calculating this, but the most common strategy used by most advisors is what they call DIME. D stands for all outstanding debts, including mortgage. And I stands for income, your annual income multiplied by the number of years your family is going to need support. M is mortgage, the outstanding balance in your mortgage, if you have one. E stands for education, and this is the estimated cost of children's education. Now, add those numbers together and then subtract any existing savings and investments, including any existing coverage, what you have is going to be your coverage gap. For example, total outstanding mortgage, $500,000. Income replacement for 10 years, 120,000 times 10 years, $1.2 million. Children education, $150,000. Debts, $50,000. If you add everything, the total is approximately $1.9 million. And then you take out any existing savings or investments or existing coverage, that gives you a defensible specific number, not a guess. Now, most Canadians that I work with are either significantly underinsured or they're paying for more coverage than they need. This calculation removes guesswork. Now, let me take you through the most common mistakes I see Canadians make when buying life insurance. Mistake number 1, buying only through their employer. Most work insurance are group coverage, and these are benefits. It's not a strategy, because once you leave that employer, the coverage ends. And if the coverage ends and your health situation has changed by then, you might not qualify for future coverage. Your personal coverage follows you regardless of the employer.